Okay, hello everyone. This is Aura Ogorian with ACAP Asset Management. Thank you everyone for joining. We're going to give it about another minute or so before we start the presentation, just to kind of give a chance everyone to kind of start logging in. You'll notice, everyone, that there's a chat box on the bottom right-hand corner of your screen. Please go ahead and use that to send us any questions you might have, or if you're not able to see the screen or you're not able to see the slides, please go ahead and let us know through that chat box, and we'll go ahead and try to correct everything. And I think we should go ahead and get started. My name, again, is Aura Ogorian. I'm with ACAP Asset Management, and today I have the distinct pleasure of having Amy Evans with us, who is a president of Colibri Insurance Services. And just before I kind of go into a brief background with Amy, I want to point out the importance of health insurance and the Affordable Care Act and just the dramatic changes that are going on in the health industry the past few years, and which is why it's so important to bring this subject matter to our audience, because as business owners or as individuals, we're so often confused with what's going on with the health insurance industries. How are our premiums changing? Our coverage is changing. So I'd asked Amy to come in as an industry expert to shine some light on some of these changes that are going on, and hopefully provide us with some guidance and tools that we can use, whether in our businesses or our personal lives, to hopefully lessen the cost of insurance. So quickly, I'm going to give a bio about Amy. Amy Evans is the president of Colibri Insurance Services, an employee benefits consulting firm that works with employers to design and implement and communicate a cost-effective employee benefit strategy in this dynamic and evolving health insurance environment. She uses her tremendous knowledge of the health insurance industry and health insurance in general to consult on a variety of projects. Prior to establishing her consulting firm in 2015, Amy was a vice president of employee benefits, a division of Blvd Insurance Services in LA, and which is part of the Levitz Group. She has over 15 years of experience in the insurance industry, and she has a degree in English and French from the University of San Francisco. Amy is an active member of the National Association of Health Underwriters and also Provisors, which is how I know Amy. She is a regular contributor to the insurance industry publications and was named one of EBA's top 10 industry trendsetters to watch in 2016. She is definitely an enthusiastic user of social media, and you can find her posting regularly about health insurance topics. So with that great introduction, I'd like to introduce Amy Evans.
Thanks, Aura. Good morning, everybody. I am really happy to be participating in this webinar in partnership with Aura and with ACAP, and excited to get into this and hopefully give you some information that you will find helpful as health insurance consumers and also as business owners who may want to offer health insurance benefits to your employees. So as Aura said, I am a 15-year veteran of the health insurance industry. I've seen a lot of changes. I worked with an insurance carrier for 10 years and then entered the insurance broker arena. So instead of working directly with a carrier, I was working on behalf of my clients to help them determine the best employee benefits packages. And I did that first with a national firm and then started my own agency, Colibri Insurance Services, about 3 years ago. And I love working with business owners, helping them navigate this very confusing and constantly changing world of employee benefits. So wanted to give you an overview of what we're going to go over today. And as Aura mentioned, the webinar is being recorded, so you'll have access to all these slides and the audio that goes with it after we finish the webinar. Things that we're going to cover today. Current challenges in the individual health insurance market. I talk to a lot of business owners who have individual coverage, so not through an employer plan, but directly with one of the insurance carriers here in California. And there are a lot of changes going on in the individual market that are making it more and more challenging to have individual coverage. And so I want to talk a little bit about those and why setting up an employer plan for your business may help mitigate some of those challenges. There are ways, or I should say there is a way for employers to reimburse employees for their individual coverage. So if you're a small business owner, maybe you have an individual policy you're happy with, maybe your employees have policies with other carriers that they're happy with, and rather than having them cancel that coverage and set up a new employer-sponsored plan, maybe as an employer you just want to give your employees money to help them cover the cost of their individual plans. There is a way to do that, and we'll talk about that a little bit. Also, I want to talk to you about a health insurance agent or broker like me can help to simplify the process of determining whether or not to reimburse employees for individual plans, set up a group plan, select carriers, select plan designs, determine employer contribution. There are a lot of factors that go into that decision-making process, and a good agent will help you to make that process as easy as possible on you and your employees. And then there are a lot of rules and requirements for group health insurance plans. If you haven't gone down that road, you may not be aware of some of the legal issues, and then also some of the insurance carrier specific issues, rules that all insurance carriers have when working with employers. And I want to talk a little bit about that so that if this is something that you're interested in pursuing, you have a good perspective on what you'll be required to do as an employer. So that's an overview of what we'll be going through today. And I want to talk about the health insurance market. I use a lot of terms that I'm used to using on an everyday basis, but I recognize not everybody's going to know what I'm talking about. So I want to define some of these terms. First, the individual market. So when I say that, I mean a plan that an individual person and maybe their family members has directly with an insurance carrier. So they've signed up separate from any employer plan. It's not through their job. They're not paying for it through payroll deduction. They're paying the insurance carrier directly. And when I say insurance carrier, I mean any one of those insurance companies here in California that offers individual coverage. That can be Kaiser, Blue Shield, HealthNet, United Healthcare. Those are all insurance carriers. So an individual plan or policy would be directly with one of those insurance companies. Covered California is the exchange that the state of California set up under the Affordable Care Act to make the process of purchasing individual coverage a little bit easier. And so it is a web-based program where individuals can go and shop for individual insurance policies for themselves and their families, and they pay the carriers directly for that coverage. So that is one way to get individual coverage. There are also group policies available through Covered California. I'm not going to spend time on those today, but primarily Covered California is used for individual coverage. So that is also generally not an employer-sponsored program. That's something that someone would purchase individually by going to the Covered California website. So you may have employees who say that they have a plan through Covered California, and that's what they mean. They've purchased it on the exchange. In most cases, when someone makes a purchase of a policy on the exchange, it is because they're getting some type of subsidy, so government money to help cover the cost of the premium.
Amy,
so then, absolutely, Ara.
I just want to remind people, if they've got questions, please go ahead and type it into the question box. We've got a couple already, but just a reminder, if you do have questions or need clarifications, type it into the question box. I promise we're going to get to all the questions at the end. We are also recording this, as Amy mentioned, so it'll be available for viewing on various different platforms. Sorry, Amy.
Perfect. No, thank you. Appreciate it. So then there are the employer-sponsored health insurance plans. So there are both small group and large group employer-sponsored plans. And this is when an employer decides that they want to make health insurance available to their employees. So the employer goes to one of those carriers I mentioned, Kaiser, HealthNet, Blue Shield, Anthem, and sets up a contract between the employer and the carrier. The employer is involved in the decision-making process about which plans they're going to offer to the employees, HMOs, PPOs, small networks, skinny networks, and the employer is also involved in contributing towards the cost of one or more of the plans that they select. And then the employer collects the premium for the insurance coverage through the employees' paychecks if the employees have any contribution, and then the employer pays the monthly bill to the carriers. So that's really what we're going to focus on today, is those employer-sponsored plans. And the carriers are very specific about small group and large group definitions. So depending on the number of full-time employees your company has, that will determine whether you go into the small group division of that insurance carrier's plans or the large group division. And even under one carrier umbrella, small group and large group are very different things. The rates are different, the plan designs are different, the networks can be different, and also the customer service is different in small group versus large group. So your company size will determine which of those you fall in. And small group is 2 to 100 employees, and large group is 101 or more. And then finally, I can't have a health insurance conversation without mentioning the Affordable Care Act. And Ara, you mentioned that in your introduction. The Affordable Care Act is a law that went into place about 7 years ago that defined what health insurance policies should include and how health insurers should behave. And it's created a lot of benefits and a lot of chaos in our industry. And the important thing when talking about employer-sponsored insurance is that if you are an employer who has more than 50 full-time employees, you are subject to certain obligations under the Affordable Care Act, or if you choose not to abide by those obligations, you will pay a penalty. So totally separate from the definition of small group and large group with the insurance carriers, you've also got to consider whether or not you are considered what's called an applicable large employer, or ALE, under the Affordable Care Act. And then you may have to follow their rules regarding what kind of coverage you offer and how affordable it is for your employees. So that's another thing to keep in mind. So moving on from that, I said I was going to talk a little bit about the individual health insurance market, because what I'm finding is the challenges in the individual insurance market are pushing some business owners who have individual plans to say, gosh, I'm not really happy with my individual plan anymore. Towards the end of last year, I saw individual premiums going up 30 and 40% when the plans renewed on January 1st. And that's untenable for plans that are already with family premium could be over $1,000. And with an increase of 30 or 40%, a lot of people just can't afford that and are not happy with that. So small group, so individual insurance holders who have businesses are considering maybe setting up a small group plan to try and keep their costs down. Important related to the Affordable Care Act was the individual mandate. Originally, the ACA required that everybody have insurance coverage or pay a penalty. And the individual mandate was designed to motivate everybody or penalize everybody into purchasing coverage so that we would have healthy people and sick people paying premiums into the insurance pool. That's the way to keep an insurance pool healthy. If only sick people are purchasing insurance, then the claims that carriers are paying out are higher than anticipated, and that means the rates have to go higher. And unfortunately, in the recent tax revisions, the individual mandate was repealed. And that's telling people that they don't have to have insurance if they don't want to. And unfortunately, that means that fewer people purchase insurance. When that happens, it means premiums go higher. And I certainly believe that some of those massive increases I was seeing at the end of 2017 are related to that change. It's part psychology, it's part economics, but the fewer people we have in the pool, the higher the premiums are going to go. So that's having an impact on the individual market. Also, Anthem was one of our biggest individual insurance policy providers in California, and they decided that they didn't want to play anymore in the individual market, and they pulled out of all but three, I believe, counties in California at the end of 2017. So there was a massive group of people who had Anthem coverage on an individual basis, and they were forced to move to a different insurance carrier when they renewed their policies on January 1st. And that was very upsetting. And Anthem does still participate in the small group market. So I have worked with some employers who really like their Anthem plans, like their networks, like the plan design. And since they couldn't have it on an individual basis, they decided they wanted to move to small group so that they could keep their Anthem coverage. So it's another important impact in the individual market. Insurance providers are super frustrated with all this chaos. So doctors' offices that just don't want to deal with this stuff anymore and employ medical billing people to try and sort all of this out for all of their patients. Providers are more and more pulling out of contracts with individual carriers and not wanting to bother with it. And so that's creating some chaos as well. And there was a big change to the rating, the way that premiums are determined for families. A long time ago, it used to be that you could get one rate for a whole family. Now in the individual market, people are rated individually, and children used to be rated with one rate for a wide number of children's ages, and then they changed that, and now more children are rated individually, and every time another person gets rated individually, it makes the overall family premium go up. So that's been another contributor to the increase in premiums in the individual market. And there were some grandfathered plans. You may have heard that term. What that means is they were old plans that were written before the Affordable Care Act came into being, and those old plans had didn't have to have all of the bells and whistles that the Affordable Care Act required of new plans. And people were allowed to keep those for a few years after the Affordable Care Act was rolled out. And those plans were generally cheaper than Affordable Care Act compliant plans because they didn't have those bells and whistles. And those grandfathered plans are expiring in 2018. So they're no longer available. So I am seeing people who have grandfathered plans who are now having to move on to ACA compliant plans. And there's a huge premium increase there because they have to they're forced to make that change this year. So lots of things in the individual market that are making it harder and harder to keep individual health insurance plans. So I talked about a way for employers to reimburse employees for individual coverage. So even with all those challenges in the individual market, you may be an employer who's happy with your plan. You may have employees who have their own individual plans and they're happy with them. But as an employer, you want to provide a benefit and find a way to help employees with the cost of their individual insurance. It used to be that a lot of employers did that, but it was non-compliant. Employers might have an employee bring a copy of their insurance bill in every month, and an employer might write the employee a check to reimburse them for part or all of that cost, or they might add some money to their paycheck. Doing any of that is a problem because it establishes a group plan and then makes that group plan subject to all the laws about employee benefits that fall under the ERISA law. So even though it seems like a nice thing to do and it seems like it's a little under the table and maybe off the books and not a big deal, it actually opens up an employer to a whole lot of problems if they get a disgruntled employee that wants to make some noise. And it is not advisable to handle reimbursements for premiums that way. So at the end of 2016, the prior administration signed the 20th Century Cures Act. And this act, among other things, created a vehicle that allows employers to reimburse employees for their individual insurance premiums and not create all those other legal challenges. And that vehicle is called a QSERA, or a Qualified Small Employer Health Reimbursement Arrangement. That is a mouthful. And a QSERA has a plan document that the employer sets up and signs, and the employer makes some decisions about who's eligible for this benefit. And once they make that decision, it has to apply to all employees. You can't pick favorites. And it allows employees to have individual coverage and submit their bills to a third-party administrator that the employer pays. And when the third-party administrator approves a claim, then they tap the employer to provide the money that then is used to reimburse the employee. So an employer can say, I want to give all my employees $400 a month towards their individual health insurance. And the third-party administrator then manages that, makes sure that the employee actually has valid health insurance, needs to see proof, and then we'll pay that $400 out to the employee when they provide the proof of their coverage. So that's really the only legal viable way that an employer can provide employees with money to cover individual health plans. But again, if a small employer has their own health insurance and is happy with it, and the employees have their own health insurance and they're happy with it, rather than upsetting all of that and setting up a new plan, a QSERA might be a viable way to provide some money in a legal and acceptable and non-discriminatory way. So let's talk about the group health insurance market. This is employer-sponsored coverage. So like I described earlier, an employer sets up a contract with an insurance carrier, and the employer is involved in the decision-making process about which insurance plans are going to be offered to the employees. And then if the employees are paying for part of their coverage, the employer makes payroll deductions, and the employer pays the health insurance bill to the carrier every month. Benefits of the group health insurance market: it is currently more stable than the individual insurance market. So where we're seeing carriers pull out like Anthem from the individual market, Anthem is still in the group insurance market. Now, we still have a lot of chaos with carriers talking about merging, and pharmacies, and prescription providers. There's all kinds of stuff going on that does have an impact on the group insurance market. But right now, I feel safe saying that the group market is more stable than the individual market. There are, yeah.
I got a question related to that. I mean, lately we heard this news about Amazon, JP Morgan, and Berkshire Hathaway kind of collaborating on something related to health insurance. Can you give us some more information about that? I mean, I think it's still relatively new, but maybe shine some light on that.
Yeah, it's interesting, and I've definitely been following it. What I anticipate they're going to do is pool all of their employees together, tens of thousands or hundreds of thousands of employees, under what's called a self-funded plan. So that's a whole different conversation, but it means that they, as a group, will set up their own insurance plan, and they'll use their money to pay claims rather than using their money to pay premium to an insurance company to pay claims. And self-funded plans are very common in the Fortune 500 sized employer groups. So my expectation is that that's what they'll do, is pool everyone together, and they'll also get a lot of data. They'll essentially, and I hope this doesn't sound too critical, they'll be using their employees' health information. They'll be using their employees as guinea pigs. They'll be getting a lot of data about their employees' prescription use and surgeries and follow-up care and chronic diseases, and they'll be able to look at that data over a huge employee population and figure out what's working and what's not working. When they figure out what's working and what's not working, that information may then trickle down to smaller employers and provide some good care management information. But I don't see what they're doing as having an impact in the near future on the small group and the large group health insurance markets that we're talking about right now.
All right, that makes sense. Thank you.
Cool. So other benefits of the group health insurance market, more plan designs. So HMOs with small deductibles and large deductibles, and accountable care organizations or ACOs, PPOs, EPOs. I know that's a lot of acronyms, but it means that overall there are a lot of different choices for an employer to make about the kind of plan that will be the best for their employees. So more flexibility in the group market than the individual market. Also more carrier participation, we discussed Anthem, and more provider participation, meaning doctors seem to be friendlier to group plans than they are to individual plans. And that makes less confusion at the time of service for employees when they go to get care and provide their insurance card. So two ways to go in the current environment if an employer wants to take care of their employees. And the first we already talked about is the QSARA option. So the benefit of that is that employees can keep their individual plans. Maybe you have one employee who loves Kaiser and doesn't want to leave. And then you have another employee who's with Blue Shield, and you have another employee who's with HealthNet. And you can see that bringing one plan in and making everybody pick from one carrier may not go over very well. So letting them keep their individual coverage and instead providing them with some money towards that premium might be, from a PR perspective, a better way to go. It's still a benefit that can attract and retain employees. So it can set a small employer apart from their competitors if their competitors aren't doing anything related to health insurance for their employees. And it keeps the employer compliant with those nasty ERISA laws I was talking about. So you remove the challenge, the problem of under the table contributions if you set up a QSARA. There is an administrative fee for setting up a QSARA, and then there's ongoing maintenance fees. So it's not free, but it is probably overall going to be less expensive than setting up a small group plan. One important point, you cannot have small group health insurance and a QSARA at the same time. So it's really a one or the other kind of discussion. And I am very skeptical that if you are an employer who already has a small group plan that you're offering to your employees, I'm very skeptical that pulling that and offering a QSARA instead would go over very well. I think QSARAs are probably best for an employer who's never offered health insurance before, so they haven't set that expectation. And again, if they've got employees who already have plans and the employees are happy with them, a QSARA could be a good way to provide some money for that. I think that's the best scenario. So the other option is to set up a small group plan. So we're going to go down that road. Gives employees access generally to better benefits than the individual market and more market stability. Gives you a way to keep the Anthem network if you had an Anthem individual plan and you were happy with that, and you can get it back in small group. It is a great way to attract and retain employees, and it keeps you compliant. There are guidelines you have to follow, but assuming you're following those guidelines, it keeps you compliant with ERISA laws. So again, if you're currently paying the employees under the table, that creates a problem. A small group health plan will help to resolve that. So QSARA is one strategy, small group health plan is another strategy. And now I want to talk just a little bit about what a health insurance agent or broker does. And I will confuse the heck out of you because I will use the term agent and broker interchangeably. Agent is my official title through the California Department of Insurance, but I consider myself a broker because I work on behalf of my clients. I'm appointed with all the insurance carriers, and I help my clients select the best coverage for them and for their employees. So I function as a broker, although under the Department of Insurance terminology, I'm officially an agent. So you see the word agent more often, but no, I mean the same thing. So an agent should understand your specific industry and your specific needs. And we'll talk a little bit on the next slide about what that looks like. But staffing companies is a niche that I have. They have very specific needs that are a lot different from a lot of other groups. Restaurants would be another example. where not only is the employee population specific, but also the way to offer benefits to them and enroll them can be a challenge if all the employees aren't sitting in one office building where you can go in and do an open enrollment meeting. So you want an agent who understands the specifics of your business. Some agents provide additional support outside of just the marketing and the placement of your insurance. So they can provide online enrollment tools. They can help educate your employees about not only the plans, but how to use them, how to get the best value out of prescriptions, how to file claims. Some agents will provide ACA reporting tools. So if you are one of those employers who's got over 50 full-time employees and you're subject to those ACA requirements, there are tools that will help you track information so that you can report easily to the IRS. Also, some agents will provide compliance documents, things like pre-tax plans and wrap documents and things you've probably never thought of if you don't have a small group insurance plan, but there are agents who will help you with those things above and beyond just the placing of the insurance.
Amy, I've got a
Yeah,
question about that.
sure.
So I know a lot of companies, especially larger companies, are trying to just kind of push you to their website and have you, troll through there to find the answers that you're looking for. But as an employer, especially if you're a large employer and you're, obviously very busy, can these HR people contact you? Like, what service do you provide that's, really above and beyond what these just, really web-based services are providing, that the HR person can just contact you and get the information they need in a 5-minute phone call and they can go back to doing what they're doing? Does that question make sense, or?
Yeah, that is what a good agent will do. So a good agent's going to know your specific company and your specific employee population, and be the quarterback and the go-between between the company, at usually the HR person, and the insurance carriers. I have clients that I talk to every day, multiple times a day. And then I have some clients who don't need me as often, but I am absolutely a part of their team to help them deal with billing issues, enrollment issues, employees who are at the dentist, but the dentist says they can't confirm the coverage. There's a lot that a good broker will do to make sure that this process is working as smoothly as possible, and work, yes, directly with the HR person as a right-hand person. Also, at renewal. So when an insurance contract is in place, it's a 12-month contract. So when it comes up for renewal, there's really about a 3-month process prior to renewal that an agent should be involved in, looking at the renewal rates and the plan changes and helping the employer to understand whether or not moving carriers or changing plans or changing contribution is a good strategy at that time. And what I found a lot with companies that work with some of those web-based services, like the one that starts with a Z, whose name I won't mention, they don't get that service. They get an email that says, hey, here are your renewal options. And they don't get strategy and conversation and consultation to help them make the best decision, because those web-based services don't want to put any time into those changes. It just costs them more the more time they have to put into it. So a good broker is really involved way before renewal time to help a client understand what the current market looks like and help tweak anything to keep affordability in the right spot for both the employer and for the employees.
All right, thank you. That's great.
Sweet. So I like to say that the best factors for selecting an agent are their strategy, their service, and their synergy. And I think we really covered that in these previous bullet points. In truth, for the most part, all agents have access to the same carriers and the same plan designs and the same rates, especially in the small group market under 100 employees. So I can't go to a carrier and get a special plan that other agents can't get to, or I can't go to a carrier in small group and say, hey, will you lower my clients' rates by a couple % just because you like me. There isn't that negotiating room in the small group market. So it's not about cost. I'm not going to show you something that's cheaper than another agent can show you, but I can tell you why this plan would be better than that plan given the things I understand about your company. And that's really the strategy that I think is important. And I think it's important to know agents are compensated by the insurance carriers. They're paid commissions on the premium for the insurance policies. So there's no additional cost to an employer for working with an agent. The commissions are already built into the rates. So whether an employer goes directly to a carrier or not, or works with an agent, it's going to cost them the same. So in essence, we are free labor, and you should fully take advantage of us because the good ones know what we're doing. But again, we're working on behalf of you and your employees to find the best coverage for you and keep it as affordable as possible. So factors that go into selecting a group health insurance plan, I've alluded to some of these. There's a lot that an agent will consider when making a recommendation. Understanding your employee demographics. A young IT company with a bunch of invincible 20-somethings is going to have different needs for their insurance than an older population that might be doing a lot of, say, diagnostic exams and cancer screenings, or a mid-age female population that has a lot of pregnancies. All of those factors will determine what kind of plan, what kind of network, the hospitalization coverage, the deductible, the prescription coverage. All of those things will vary depending on the age and the gender and the life stage of an employee population. So that should be taken into consideration. Geography is important. There are certain carriers that are really good in Southern California, but terrible in Northern California. So if you have employees in both locations, that should be taken into consideration. Kaiser is great. I'm a big fan of Kaiser. I think it's best when the employees are relatively close to one of the big Kaiser facilities. That's not a blanket statement, but I think that's when Kaiser works the best. So considering how big the networks are and whether or not your employees have access to enough doctors in their home zip codes is really important. A plan may have a really skinny network of not very many doctors close to your place of employment, and that plan may look really cheap, but if employees live out in places like Palmdale or the Inland Empire and the network doesn't extend out there, that's not going to be the greatest fit. So that would be something that a good agent would take into consideration. Network adequacy, if you already have doctors that you care about, then we have the ability to run a provider check to see if those doctors are in other carriers' networks. Plan design, I mentioned copays, deductibles, co-insurance, prescriptions, hospitalization, emergency room, urgent care. All of those things are factors that can make the cost of a policy go up or down and should be taken into consideration with your specific employee population again. And then employer and employee contributions. So there's a premium for a policy, and an employer in a group coverage situation is required to contribute towards the cost of that. And then that may leave some that the employee has to contribute as well. So understanding what the employees can afford, what the employer can afford, giving employees maybe buy-up options if there's a basic plan that the employer pays for, but if the employees want a fancier plan, they can throw in a little of their money to buy up. All kinds of strategies there. Special programs, carriers are doing special things all the time. If you bundle dental insurance and vision insurance along with your medical, you can get a 5% discount, or normally we require 75% of employees to participate, but right now we'll take a new group at 50% of employees. All those things are happening all the time, so a good agent is going to help you figure that out. And then there are ways to have multiple carriers in one employer contract, even in small groups. So you may have 3 employees who want Kaiser and 4 employees who want Anthem. And normally you wouldn't be able to go directly to Kaiser and say, I just want to put a few people on, and go to Anthem and say, I just want to put a few people on, because typically the carriers want everybody under one contract. But there are ways to offer multiple carriers under one contract. And again, a good agent can help you figure that out if that's a good option for you. So, general insurance carrier requirements. If this is a road that you want to go down, what are the carriers going to require of you as an employer? Typically, at least one W-2'd employee and 6 weeks of payroll. Now, I mentioned carrier specials. I have seen carriers say, forget the payroll. We don't need to see that. If you have a contract already with an insurance carrier and you just want to move contracts, they may just want to see the bill from the prior carrier. But if you're setting up a contract brand new, generally at least one W-2'd employee and 6 weeks of payroll and proof of full-time employment status for the employees on payroll. So they might want to see quarterly DE9C that shows all the employees that were paid in the previous quarter and what their hours were and what their wages were, or they might want to see payroll records. All of this is set up to avoid 2 people getting together and going, hey, let's just incorporate so we can get good health insurance. So the carriers are careful about avoiding that. That's what these requirements are for. Also, a carrier is going to require an employer define eligibility. So who of your employees is eligible for this coverage? And that is, those are rules that apply across the board. And typically it's an employee who works 30 hours a week or more for you and can sign up for coverage after a probationary period, which can be as little as first of the month after date of hire, or first of the month following 30 days, or as long as first of the month following 60 days. So that's the longest that you can make an employee wait after they've been hired full-time before they are eligible for coverage. So an employer defines that. Also, the employer determines the contribution. Typically, the lowest contribution an employer can make under a group contract is 50% of employee-only coverage for the lowest cost plan. So you may only offer one plan, and then it would have to be 50% of that. But you may offer an HMO, which is typically sometimes cheaper than a PPO, and you may choose to pay 50% of the HMO. But if employees want the PPO, they would pay the difference in cost between what it would cost for them to be on the HMO and then what it would cost for them to be on the PPO. And that's called buying up. So an employer would have to understand that there would be an employer contribution to the cost. You can't set up a group contract and say, the employees are going to pay for it all. There is some employer financial participation. And then participation requirement. The carriers want to know how many full-time eligible employees do you have and how many of those are going to sign up for your coverage. And they typically require somewhere between 25% and 75% of your eligible employees. And minus valid waivers means if someone has a valid insurance coverage somewhere else, like say through their spouse's employer, that means that your employee who has coverage through their spouse is considered a valid waiver, so they're not counted in the overall participation total. And some carriers count individual coverage as a valid waiver and some don't, so it really depends on the specific insurance carrier that you work with. And also non-discrimination is really, really, really important. So I know with small employers, a lot of times, especially when they were born really, really small, maybe off a kitchen table or out of a garage, and they employed family members and friends and college buddies, there might be a lot of special exceptions that are made for particular people. But in the group health insurance environment, you cannot make special exceptions. If you're going to provide coverage for anybody working 30 hours or more who's been with you for at least 60 days, you got to provide it to everybody. You can't leave somebody out or pay less for their coverage, or pay 100% for one person's because you really, really like them, but you're only going to pay 50% for everybody else. The non-discrimination rules that fall under ERISA are really, really important to follow. So know that if you set up a group plan, you're going to have to abide by those rules. So, additional considerations. This is the last slide, and then we'll get to questions. Employee communication. If you're going to offer a group health insurance plan, in my opinion, you want employees to understand the value, because you're going to be, as an employer, contributing money towards the cost of it. So it is a benefit for them. It increases their overall compensation. And you want them to understand how to use the coverage. There's no point in providing coverage and then not helping anybody figure out what to do when they get sick or hurt or need to fill a prescription. So education about the coverage and the value of it and helping them enroll is something that's part of setting up a group insurance plan. So once you've decided how much you want to pay and what plans you want to offer, then you actually need to roll it out to the employees and help them make their selections. And a good agent would help you with open enrollment meetings and employee communication to accomplish that. Payroll deductions. So if you're an employer offering a group plan, if employees are contributing to the cost at all, then that money that they're contributing would come out of their paychecks, and you would have to enter payroll deductions and then use that money plus the money you're contributing to pay the carrier bill on a monthly basis. So setting up payroll deductions is an important part of the process. There'll be a monthly invoice payment to the insurance carrier that you as the employer would have to manage. You might want to have a premium conversion plan. It's got a million names: POP plan, premium only plan, cafeteria plan, section 125 plan. It all means the same thing. It allows you to deduct employee contributions on a pre-tax basis, which means employees don't pay income tax on the money they're using for their health insurance premium, and you also don't pay payroll taxes as an employer. So it's a benefit for both you and the employees, but you have to set that up to be able to do it properly. It's easy, but it's important to have it, because if you don't, there can be penalties down the road. And then ongoing administration for new hires and terminations. So as you hire employees, they're subject to the same waiting period, the same eligibility. So once they satisfy their eligibility period, they have to be offered coverage. Typically, you would give them a packet of information, give them a deadline by which they have to make a decision, fill out their application, submit their application, and then make sure that they get enrolled and start their payroll deductions. And then the reverse for terminations. If somebody's enrolled and they leave your employment, you would notify the carrier of the termination so that they would be removed from your bill. So that's some ongoing administration. And then we've talked a few times about adherence to ERISA. So a good broker is going to help you understand what your requirements are under the law, but you ultimately are responsible as an employer for adhering to ERISA requirements. So that's something you would want yourself or your human resources person to be aware of and assisting with. So I think I have covered a heck of a lot, and I'm sure we've got a couple questions that I am happy to answer.
Yeah, we definitely covered a lot of information, and boy, that was very, very comprehensive, Amy. Thank you very much. And we do have a lot of questions, and I'm not surprised given the importance of this topic, and everybody has the need and the requirement for health insurance. So let me go ahead and I will moderate the questions. I'll start asking them because they're popping up on the chat box, and I'll ask you, and then you can go ahead and answer them, and then I'll go ahead to the next one. If we can kind of keep the answers short, that'd be very helpful, so that way we can go through all the questions.
Yep.
So the first question is, can you have a small group health plan for some employees and a QSERA for others?
You cannot. It is one or the other.
Okay, all right. Relevant to this slide, I'm not sure which slide they were referring to, but how much time does it take to set up a group contract?
Great question. I would recommend at least 2 months prior to whatever the effective date is. So if I was working with a group right now, mid-March, I would say we certainly don't have enough time for April 1st. We may have enough time for May 1st, but I would say probably June 1st, because you've got to collect a census, get the census out to the insurance carriers, get the quotes, analyze the quotes, make the decisions about which plans and what the contributions are, and then set up open enrollment to educate the employees about all these decisions. So it's not an impossible process. I do it all the time, but I think 2 months is a good, healthy amount of time to be able to make good, solid decisions.
Okay. The next question, which I think is related to what you just answered, is when can an insurance contract be initiated? Is that kind of the same thing that you're just asking?
That's a great question. A lot of business owners have calendar year in their heads, and I understand a lot of things related to finances or calendar year. And so there's a perception that the only 12-month cycle that your benefits can be on is January 1 through December 1. And a lot of companies are on that cycle. But the truth is, you can set up an insurance contract to have an effective date, always the first of the month, but any first of the month throughout the year. And my recommendation is to avoid fourth quarter, avoid December 1st and January 1st particularly as much as possible, because about 80% of group contracts renew either December 1st or January 1st. So everybody is completely insane at that time of year. It's like tax time times 100. So any other time of the year you can set one up.
Well, as a accounting firm and tax firm, we definitely know what that feels like. So the next question is how can an employer forecast or budget their health insurance costs? Is there like a good inflation factor? Like if you're an employer and you're trying to forecast a cost going out?
Yeah, that's a great question, and there's two parts to that. So the first is, as somebody who's been in this business for 15 years and talks a lot to a lot of insurance brokers, our general feeling is that an increase of under 10% is not bad. So if I get a renewal for a client for a contract that's renewing, say June 1, and it's less than 10%, that's a good starting point. That doesn't mean I'm not going to look at other options and make recommendations on how to reduce costs. But I would say if you're budgeting, 10 to 15% year over year is a reasonable expectation. Now, I'm saying that in the middle of March of 2018, I have no idea what's going to happen 6 months or 12 months from now with carrier compression and changes in the laws, and it's complete wild, wild west. But right now, if I was recommending that a client, forecast an increase, I would say 10 to 15%. And then the other part of that's really hard in small group is that the rates are based on employees' ages. So if you're contributing 50% of the employee premium, what you contribute as an employer for a 21-year-old is a lot less than what you contribute as an employer for a 51-year-old. So budgeting your costs is hard if you don't know the age of the people you haven't even hired yet, which I know is frustrating, but I don't have a good workaround for that.
Okay. That, I think 10 to 15% is just absolutely crazy. I mean,
it is.
Your increase. Okay, I'm going to limit it to the next two questions because we're running out a little bit of time. But so two more questions, and then if there are any other follow-up questions, please. As I said earlier, this is going to be recorded. This is being recorded. We're going to post it on our social media, on our website. There'll be plenty of opportunities for you to ask follow-up questions. But let me go to the last two questions, which is one is if the cost becomes too prohibitive for the employer, can they stop the coverage? Can they easily do that? I know there's, a goodwill issues with their employees, but
yeah, the answer is yes. I've had that happen with a client, and they're not locked into the 12-month contract. So if someone starts on June 1st and by December 1st they say we just can't keep going with this, they can absolutely cancel the contract. There's no penalty. But you're right that there's a big goodwill problem if that happens.
Okay. And then last question is, I think I already know the answer to this one, but I got to ask it since it's in here. Can you have a plan that benefits the executives versus the employees? So if I'm assuming this means like if you've got highly compensated employees or, owners, can you have one that benefits them more than the employees?
So there are ways to do that by class of employee. It's very specific. So you have to play by the rules, and the rules may not always fit what you're trying to accomplish. And know that built into the Affordable Care Act was an elimination of the ability to do that, but that's been put on hold, although it could be passed at any time. So right now you can still do that. You still have to follow carrier rules like salaried versus hourly, management versus non-management. There are ways to do that, but that that the ability to do that already has a sunset on it built into the Affordable Care Act.
Okay, perfect. And more importantly, oh, I was just going to ask that question. How can people get a hold of you? And there it is. So
everywhere.
everywhere. Amy is ubiquitous, so, or omnipresent. So you can contact Amy through social media, her email, phone number. Again, this is being recorded, so this is going to be available for you. I want to thank Amy for doing this presentation. It was enormously helpful, not only for me, but also for our clients, our audience. Any last words, Amy?
Thank you. I appreciate your time, and I'm happy to be a resource for you if you have more questions about this.
Thank you again. And this ends our presentation. It's also a part of a series of presentations we're going to do to educate our clients and also our audience on different subject matters. This particular one was about health insurance costs, group health insurance costs for employers, but we're going to have other subject matters as well in the future, so please stay tuned. And thank you again for participating. Have a good day, everyone.